Hello, and welcome to episode 11 of Thick Sustainable Infrastructure Finance. I'm Karen Kuby, and I'm joined today by Bill Fitzgerald, who will explain why deciding between two sustainable investments at different points on the risk spectrum is a false Hobson's choice.
Thanks, Karen. For the past several years, fixed sustainable infrastructure bonds had lower returns than technology stocks, like FANG stocks. So I'm often asked, why should I invest in fixed sustainable infrastructure bonds when I might receive a greater return from investing in new emerging technologies that may be the solution to environmental sustainability? The question is a classic Hobson's choice. In our opinion, this isn't an either-or choice. Let me explain. The question posed only considers the performance dimension of an investment. Yes, generally speaking, investments in emerging technologies can offer higher expected investment returns than high-quality bonds, like fixed sustainable infrastructure bonds. But risk is the other side of the investment equation. Let's look to widely accepted models for making investment decisions. This is a picture of what is called the securities market line. It is the primary construct of the capital asset pricing model that is taught in most courses on investing. It demonstrates the relationship between return and risk. This graph has investment return on the vertical axis and risk on the horizontal axis using standard deviation of the security price, and plots the return and risk relative to the market portfolio, which is an aggregate portfolio of all available investments, like an average portfolio with everything in it. And it shows that investments with higher return also have higher risk. Stated in a different way, investments with higher return may also bring about the risk of higher loss of investor capital. Now we can look at the security market line and place on the risk-return continuum the various types of investments in sustainability. Here you see where we think we would place these likely investments. Investments that offer the potential for high return, like technologies funded by venture capital, are further on the risk spectrum than fixed sustainable infrastructure bonds, which have lower returns but lower risk. Examples of technologies that seek to address the challenge of climate change include carbon capture, hydrogen fuel cells, and geoengineering solutions that involve large-scale manipulation of physical, chemical, or biological aspects of the ecosystem. We have tremendous confidence in the innovation engine of the United States and other countries for which the capital markets provide funding. But we also need to be realistic. None of the technologies that I mentioned are currently viable. Some of them may break through, but look at the data of outcomes in VC investments. According to Mark Andreessen, the founder of noted VC firm Andreessen Horowitz, for those startups that receive venture capital funding, only 8% succeed in making a profit. Only 8%. High risk accompanies the high expected return. So recall modern portfolio theory, introduced by Harry Markowitz in 1952 and still used in portfolio construction today. Markowitz described the value of diversifying investments in a portfolio by mixing lower risk, lower return investments with higher risk, higher return investments. And this graph depicts this. What it shows is the risk and return of combinations of investments that mix high risk with low risk and vice versa. Venture capital and geoengineering will be far on the right side of the line, and thick sustainable infrastructure bonds will be on the left side of the line because they are lower risk and lower return. The key takeaway from examining the efficient frontier is in how the slope of the line changes when you move from one end to the other. If we start with high-risk investments like venture capital and add higher risk investments like geoengineering, we get higher risk without much higher return. On the other hand, if we start on the left side of the line with thick sustainable infrastructure bonds, low risk and low return, and then add higher risk investments like venture capital-backed technologies, then we get a meaningful increase in portfolio return for a relatively small increase in risk. This is the benefit of diversifying investments in a portfolio. The sustainable marketplace offers this continuum of risk and return, just like the broader investment market. The riskier end of this continuum includes investments in emerging but unproven technologies that offer the higher potential for return. The less risky end of the continuum includes investments in thick, sustainable infrastructure. Investors can combine investments in the technologies that may one day help in addressing society's challenge with climate change and, at the same time, invest in solutions with an immediate impact, like thick, sustainable infrastructure. Investments in technology have potential payoffs many years in the future, both in terms of financial returns and environmental performance. In contrast, thick, sustainable infrastructure offers financial and environmental returns in the here and now, current income, greater liquidity than venture investments, and immediate impact on preserving or restoring natural capital and resiliency to the impact of the changing climate. So in reality, the perceived Hobson's choice is false. It's not an either-or decision. Investors can do both. They can invest in the solutions of tomorrow and invest in the solutions of today in a single portfolio that includes long-range equity investments in technologies and near-term investments in thick, sustainable infrastructure.
Thank you, Bill. We hope that this helps to clarify how to think about diversifying your sustainability portfolio across the risk spectrum. Stay tuned for more information on thick, sustainable infrastructure finance. And if you haven't done so already, please subscribe to our channel. As always, please tell us what you think. We always learn from our colleagues.